This video explains how Trading Conceiver computes profit and loss and what options can be selected. In order to access the profit and loss controls, select the Profit tab. Calculations are performed within this time range. By default, the first and the last dates available in the historical file are selected. You can select any interval to calculate the profit in a different time frame. The fixed fee per trade is the fixed fee or commission to pay to the broker, both at opening and closing of each operation. It is also known as fixed broker fee, fixed brokerage fee, fixed trade commission, flat fee, per trade flat fee. The percentage fee per trade is the percentage fee or commission to pay to the broker both at opening and closing of each operation. The percentage is calculated with respect to the invested capital, that is, it is a percentage of the transaction value. Note that it is a percent, not per mile. Note also that it is not a per share rate where a price is charged for every share traded. It is also known as percentage broker fee, percentage brokerage fee, percentage trade commission, floating fee. The capital gain tax is the tax to be paid on the capital gain as a percentage. Capital losses can be used to offset capital gains on tax return. If you check the capital loss is tax deductible checkbox, if you have already incurred in a loss, then you can use that loss to offset the capital gain used to calculate the capital gain tax in the subsequent winning trades. The initial capital is the initial capital or balance in any currency you are using. The slippage per trade is a worsening of the profit, also known as negative slippage. The trading prices reported by Trading Conceiver are theoretical, but in reality buying and selling could occur at prices slightly different due to many reasons: gaps, delays, low volumes. This could result in more favorable or less favorable prices. The slippage considered here is always less favorable and reduces the profit per trade by the indicated percentage. So it is calculated only once per trade, when closing the position. Note that it is not a percentage relative to the trading price, but to the profit and loss. The leverage is the magnification of the price movement. The profit and loss of each trade is multiplied by the factor input here. For instruments with no leverage, like standard stocks, input 1. The leverage is increased by some derivatives, options, swaps, futures. For the annual return, please refer to the dedicated section. The calculation of profit, capital gain, taxes, and so on depends on national legislation. Each country has different rules and each financial instrument has its own. We use a general model to compute all these quantities. However, be aware that this may not match exactly your case. So be sure to understand the assumptions taken by Trading Conceiver and that the real performance could deviate from the one thus calculated. When opening a position, all the available capital is invested, taking into account the brokerage fees, both fixed and percentage. When closing an operation, the following steps are taken in this order. A profit is calculated by comparing the prices when opening and when closing the position. This profit is worsened by the slippage. This is a pretty strong assumption because in reality slippage sometimes will worsen but sometimes will improve performance. We're assuming it is always unfavorable. The result is multiplied by the leverage. The capital is updated based on the profit. The brokerage fees are calculated, both fixed and percentage, and are subtracted from the capital. The capital gain is calculated by subtracting the broker fees for opening and for closing the operation from the profit. This is an important point because we are assuming something favorable for the trader. The capital gain, upon which taxes are based, is reduced by brokerage fees. This might not be the case for you. The capital loss is taken into consideration. If the capital gain is negative, the capital loss is increased by an amount equal to the capital gain and no further actions are taken at this step. If the capital gain is positive, there are two options. If the capital loss is not tax deductible, no actions are taken here. If on the contrary the capital loss is tax deductible and there are previous losses, the capital gain is reduced as much as possible according to previous losses. That is, if previous losses are greater than the capital gain is considered zero. If previous losses are less than the capital gain is reduced by an amount equal to the capital loss. The capital loss is updated, reduced accordingly. Taxes are calculated based on the remaining capital gain. If the capital gain is negative or zero, no taxes are to be paid. If the remaining capital gain is positive, taxes are calculated as a percentage of it. The real profit of the operation is computed, taking into consideration all the previous steps. Furthermore, to make the profit more realistic, it takes into account that before opening the position, the real capital was not only that resulting as the capital after the purchase, but there was also the opening position broker fee. So in order for a profit to be positive, not only the price must move in the right direction, but it must overperform brokerage fees too. This reflects the considerations about the capital gain, so that they have the same sign. So it might happen that the capital increases after a trade, but the profit is negative. This is the profit, for instance, listed in the table. In case of a stop and reverse, that is, when a position is closed and the opposite position is open right away, the fees and capital reported in the table are the final ones, after the opening of the new position. All the following part of this video pertains to the annual return and to what is needed in order to calculate it. Annual return is the average yearly return and appears in the statistics window. In order to compute it, it's necessary to know the time span in the historical file. This is required only if you are interested in the annual return. For all other metrics, in statistics and all other features in general of Trading Conceiver, date and time as expressed in the historical file don't need to be understood by the software. If you want to know the annual return, follow the following steps. First off, select the main tab Profit. Select the checkbox Enable Annual Return Calculation. If this checkbox is selected, the annual return will be calculated and shown in the statistics. As a corollary, other metrics will be calculated and shown in the statistics, such as the trading period in days and years and entries per year. If the checkbox is not selected, the annual return will not be calculated and will not appear in the statistics. By selecting this checkbox, you can select the method of your choice to indicate to Trading Conceiver the time span in the historical file. Each method is represented by a radio button. You need to fulfill only one method, not all of them. We suggest you try the methods in the order they are presented here. The method applied when computing the statistics is the one selected by the radio button. Once you find a certain method, except the Enter Dates one, works properly, you can leave it selected for all historical files with the same date-time format. With the Auto-Detect method, Trading Conceiver will try to auto-detect the date and time format. Try this option first. If date and time are expressed in a reasonably standard way, it will detect the format correctly. Two dates times are shown, the first and the last in the historical file. Look at the day, month, year, hour, minute, second fields to check if dates, times have been interpreted correctly. If so, no further actions are required. Leave the Auto-Detect radio button selected. Otherwise, select another method. With the Periodicity option, you can enter the periodicity of the data in the historical file. For instance, if the historical file contains daily data, select Daily. The radio button Less than daily means there is more than one entry per day, like hourly, 5 minutes, or else. The spinners are enabled only for some radio button selections. In the spinner holidays per year, enter the number of holidays when the stock exchange is closed, like New Year's Day, Christmas Day, national holidays. In the trading days per week spinner, enter the number of trading days per week. For instance, if the stock exchange occurs Monday to Friday, they are 5 days. In the entries per day spinner, if there is more than one entry per day, enter the number here. For instance, if the periodicity is hourly and the exchange occurs for 9 hours, enter 9. You can enter decimal numbers, not just integers, in order to fine-tune the input. As an example, suppose there are 11 days per year in your country during which the stock exchange is closed, and the trading days are Monday to Friday. You might want to fine-tune your input, calculating that, statistically, those 11 holidays have a probability of occurring between Monday and Friday of 5/7, equal to 0.7. That is 5 trading days per week and 7 days per week in total. So in the holidays per year spinner, you could input 11 times 5/7 equal to 7.86 instead of 11. In the entries per year pane, you have to input the number of entries, or bars, in your historical file per year. They can even be decimal numbers, not necessarily integer. In order to do that, you need to consider the periodicity of the data in the historical file. If the data in the historical file are yearly, obviously you have to enter entries per year 1. If your data are monthly, there are 12 months in 1 year, so enter 12. If your data are weekly, there are 52 whole weeks in 1 year. More precisely, considering 1 leap year out of 4, statistically, there are 365.25 days per year. So there are a little more than 52 weeks in 1 year. So enter 52.18. Typically, it is considered there are 252 trading days in 1 year, considering 5 trading days per week and holidays. Indeed, trading days are 5 days per week times 52.18 weeks per year, equal to 260.9, to be reduced by the holidays, but this completely depends on your country and the market you are trading. If your data are less than daily, for instance hourly, you can start from the 252 trading days per year of the previous section and multiply it by the number of bars per day. For instance, for hourly data, if there are 9 bars per day, input 252 multiplied by 9 equal to 2268. In the date pattern pane, you have to enter the format used for dates and times in your historical file. The format is expressed through specific symbols. The first date and time in the historical file is shown. Enter the pattern and press the button Apply Pattern. Then look at the day, month, year, hour, minute and second fields to check if the date and time have been interpreted correctly. If so, no further actions are required. Leave the date pattern radio button selected. Otherwise, select another method. For the symbols to be used in the pattern, please refer to the manual or look at the tooltip. In the Enter Dates panel, you have to manually enter the first and the last dates of the historical file. Leave this as the last choice. It will be reset whenever you load another historical file. If any of the day, month, year, hour, minute or second is not present in the file, select a 0 in the spinner.